Hi, good morning from the Money Show. I'm Amelia Bordeaux. I'm the founder of Market Compass, and I am here this morning with Christine Benz, and she is the director of personal finance for Morningstar.com. She is a senior columnist also at Morningstar.com. She's the author of several books and the former director of Morningstar.com's mutual fund analysis. Good morning, Christine. I'm so happy you could join us.
Thank you.
I wanted to start off with a question that's relevant to the recent price activities in the market, which is U.S. equities. They fell so heavy in December, as you know, and then we had a strong bounce back in January. So if you're a long-term investor in a retirement account, should you attempt to manage through this volatility, or should you attempt to just hands off and leave it alone? What do you think?
It really depends on your life stage. So if you're a truly long-term investor, and there I would say anyone under age 50, you probably do want to sit tight with as equity heavy a portfolio as you can withstand. The type of portfolio where you won't do anything crazy with it and upend the plan at the worst possible time. So you'd want an equity heavy portfolio mix. If you're edging toward retirement, if you're someone who is, say, within 10 years of retirement, there I think it's time to use the fourth quarter market volatility as an opportunity to revisit the risk in your portfolio, potentially take some chips off the table in equities which have performed so well for so long. And move some money into safer securities. So we've got cash yields, which have come up really nicely. You'd want a percentage of your portfolio in bonds, even though bonds have gotten jostled around with some interest rate related volatility. But you'd want to take some chips off of your equity portfolio and move them to safer parts of your portfolio. If you're someone who's well into retirement, say you've been retired for 10 or 15 years, you have made it through the difficult years of risk.
That's great. You've made it.
You've made it. So don't worry about big losses in your portfolio because you're less subject to what retirement researchers call sequencing risk, encountering a bad market environment right at the beginning of your retirement.
And are those the people who are most vulnerable, or who you guys are most worried about when you see market volatility? Is that the age group or the group?
I'm worried about all investors because one thing we know is that investors can undermine their own results by selling themselves out of asset classes at the worst possible time. They sell themselves out at the bottom. So I'm worried across groups, but I would say if there's one of those three age bands I'm most worried about, it's the people who are just embarking on retirement because they've had a great equity market environment. A lot of them have been quite complacent about equity risk. And I think that there is probably a real risk over the next decade that we'll have fairly muted equity market returns.
Great. And how often should you review your allocations? If you're a long-term investor, you're kind of at the start of your retirement savings. You're not too far along. You maybe have 20 years to retirement. How often should you be reviewing those sector allocations?
I would say one of the greatest pieces of investment advice ever came from Jack Bogle, the late Vanguard founder. He said that long-term investors shouldn't peak, don't peak. And so I think once a year for most of us is absolutely plenty when it comes to reviewing our portfolio allocations. If you look too often, if you're watching your balance kind of go up, down, sideways on a day-by-day or month-by-month basis, I think you're more inclined to do trading that probably in hindsight you wish you would rather not have done.
Great advice from Christine at Morningstar.com, and we're going to come back with more expertise from Christine in a few minutes. Thank you.
Thank you.